Hi, Dr. Dolly. I was wondering if you could give a brief history on real estate investment trusts, suggestions on what to look for before investing in a REIT, and subsequently, what options investors may have when REITs go bad. I have about 10% of my investment set up for real estate, most of which is tied up in the Peak Housing REIT, which, from my understanding, you also have funds invested. At the beginning of August, they sent out a pretty depressing update, and after some emails back and forth, due to rising interest rates, bad decision making on their part, and needing to pay off a preferred equity holder, it looks like of the 175,000 I have invested, I at best may eventually only receive about 40 to 60% of my investment back. Any suggestions? Thanks for all that you do.
All right. So this question from Kyle, let's take the general view of this. He's talking about real estate investment trust, but I think this can be broadened as well to just about any real estate investing opportunity. What advice would you give to Kyle about evaluating these and then what to do once, if one of them's not going so well?
Yeah, well, the benefit of a REIT or a fund like MLGs is the opportunity for diversification. I think as a general investing principle, whether it's real estate or stocks or anything else, unless you're a very specific expert in the field in which you're investing, diversification is a good rule to live by. And REITs provide that. So does a fund like ours. But I think what we're learning in the market right now is the next thing you should look at is a time-tested manager. There are a bunch of real estate companies that sprung up in 2016 through 2022 that all made a bunch of money for a couple of years, but had never been through a cycle. And many of those are the groups that are now having issues, with their debt maturities and things like that. So I would say it's important to be with a manager with a good track record, and then evaluate the risk profile of the deal as well. If you're an older investor looking to wind down your career, you're probably not looking for a bunch of development deals that have a higher risk profile when there are opportunities out there where you can invest in already existing high quality real estate that has existing cash flow. So considering the risk return balance that you're looking for is important too.
Yeah, and there's more than just the risk of the real estate itself, right? I mean, obviously, a ground up development's going to be riskier than, a Class A core holding that's already fully rented out. But the deal itself has got risk in it. How much leverage is being used? What kind of leverage is it? Is it short-term variable rate debt that's going to have to be refinanced halfway through the deal? There's a lot to walk through here. I mean, we put together an entire online course to help people evaluate, real estate deals. But I absolutely agree with your first point, which I think is the most important aspect of investing, whether it's real estate or anything else, and that's diversification. Because diversification protects you against what you don't know, but it also protects you against what you can't know. And when a deal inevitably goes bad, it sure is great if it's not a huge piece of your portfolio. If it's a tiny piece, then it's a whole lot easier to stomach the fact that it's not going so well. But let's say you're in a private deal and things have kind of turned south. What advice do you have for somebody that's in an illiquid deal that's not going well?
Yeah, unfortunately, as an LP investor, there's oftentimes not a lot of control or things you can do once you're already in a deal. I would say probably the biggest advice I would give people is use it as a positive lesson to not make the same mistake again. Um, Once you're in it, I think there's limited things you could do. There are some opportunities if you end up realizing a loss. Those losses could be useful to shelter some gain elsewhere in your portfolio. Definitely worth a conversation with your CPA on that front. But the biggest thing is don't make the same mistake again, but also don't be afraid of continuing to invest. There's always opportunity in the market. You just need to be with the right groups that can identify and still produce returns in a risk-adjusted way.
Yeah. That's the thing with most of these, passive deals where you are, a limited partner is your due diligence has to be done all up front because then you're along for the ride. And it might be a year, it might be 3 years, it might be 12 years. You're along for the ride. Things go well, you're along for the ride. Things go poorly, you're along for the ride. I've had a couple of deals that I would describe as not going well. One of which was a fraud problem. The operator was actually fraudulent. And the second of which was kind of an incompetence problem. In the first case, it's probably going to be a total loss for me. In the second case, it's going to be a significant loss of principal for me. So this stuff does happen. And this is a reason why, expected returns have to be higher to make up for the fact that not all of these deals do well. This is one of the big reasons I think it's helpful to be in a fund rather than individual syndications. Get that additional diversification from multiple assets in the fund, but you still have one manager or one managing team. And so it's a good idea to also diversify between managers by using multiple funds, in my experience.
Yeah, I agree with that. And when you look at an individual deal versus a fund, you should always expect a higher rate of return in an individual deal. For those that have spent some time in the actual models, playing with the projections, you learn quickly that the numbers are very, very sensitive to minor changes. And even if an individual deal pencils to greater than a 20% IRR, even if you miss on your rent growth by $50, which $50 a month doesn't sound like that big of a deal in theory, it can have a huge impact on your total return. And that's why, like you just said, in a fund, you can kind of some outperform, some maybe don't perform exactly as planned, but you have a base of diversification that matters a lot.
Yeah. Yeah, those pro formas really are pretty easy to make look good. It doesn't take much tweaking to do it. And I've had some funds, that have gone round trip or nearly round trip, and 15 assets maybe in the fund, and at least one, they just mailed in the keys. They said, "We are not making any money on this property. We basically had a total loss in that fund," and yet I still ended up with double-digit returns on the fund, despite the fact that one of their properties was a total loss. So, diversification is important. These deals don't all do awesome, and there's significant leverage involved, and that's risky.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.